Most people know about the regular Roth IRA, $7,000 per year, tax-free growth, completely tax-free in retirement. And last video we covered the backdoor Roth for high earners who are over the income limits. But today we're going to a completely different level. There is a strategy called the Mega Backdoor Roth that allows certain employees to contribute up to $43,500 per year in additional after-tax money to a Roth account, on top of the standard limits. That is not a typo. $43,500, above and beyond your normal contributions. Over 30 years at a 7% return, that kind of annual Roth contribution doesn't just add to your retirement, it transforms it. We're talking about the potential for over $4 million in completely tax-free money at retirement from this strategy alone. Let me show you exactly how it works and whether you can use it. Most people only know one 401k limit, the employee elective deferral limit, which in 2025 is $23,000 per year, or $30,500 if you're 50 or older. That's the amount you personally contribute from your paycheck. But there's a second, much higher limit that most employees never think about, the total combined contribution limit under IRS Section 415, which includes employee contributions, employer contributions, and any additional after-tax contributions. In 2025, that total limit is $69,000, or $76,500 for those 50 and over. So here's what that means in practice. You contribute $23,000. Your employer matches, say, $5,000. That's $28,000 total. The IRS still allows up to $69,000. That means there's $41,000 of space left inside the 401k that most people never touch. The Mega Backdoor Roth is the strategy for filling that space with after-tax dollars and then converting them to Roth. And yes, the numbers will vary slightly based on your specific match, but the principle holds. There's almost always a massive gap between what you contribute, what your employer contributes, and the IRS maximum. The regular backdoor Roth goes through an IRA and maxes at $7,000 per year. The Mega Backdoor Roth goes through your 401k and can reach $43,500 per year or more, depending on your employer's match. Here's the mechanics. Your 401k plan must allow after-tax contributions beyond the standard $23,000 pre-tax or Roth limit. Then, once you've made those after-tax contributions, the plan must allow one of two things, either an in-plan Roth conversion, where the after-tax money is converted to a Roth 401k within the same plan, or an in-service distribution or rollover, where you roll the after-tax money out of the 401k and into a Roth IRA while you're still employed. Both paths accomplish the same goal. Your after-tax dollars end up in a Roth account where they grow tax-free and come out in retirement completely tax-free. The contribution was already taxed, so there's no tax on the conversion itself, as long as you convert before those dollars earn any investment returns. That's why people often contribute the after-tax amount and convert it immediately, sometimes the same day. Here's the honest answer: not everyone can use the Mega Backdoor Roth, because it requires your specific 401k plan to support it. Large employers, especially technology companies, financial institutions, and many large corporations, often allow both after-tax contributions and in-plan Roth conversions. Google, Microsoft, Amazon, many law firms, hospitals, and financial services companies have plans that support this. Smaller employers often don't. The plan document governs everything, and your HR or benefits team will have the answer. The 3 questions to ask are: does our 401k plan allow after-tax contributions beyond the pre-tax limit? Does it allow in-plan Roth conversions? And if not, does it allow in-service distributions or rollovers while I'm still employed? If the answer to any of those is yes, you may be able to use the Mega Backdoor Roth. If the answer to all 3 is no, then the strategy isn't available to you in your current plan, but there are alternatives, which I'll cover in a moment. Also worth noting, if you're self-employed and have a solo 401k, you have full control over your plan document. Most solo 401k providers, Fidelity, Vanguard, and several specialized providers, can structure a solo 401k to allow after-tax contributions and in-plan conversions, making the Mega Backdoor Roth fully accessible to the self-employed. Assuming your plan supports it, here's how to actually execute this. Step 1. Log into your 401k plan portal and look for after-tax contributions in the contribution settings. This is separate from your regular pre-tax or Roth 401k contributions. Set this to whatever percentage of your paycheck is needed to reach your target. Many people who do this aggressively set after-tax contributions as high as possible, up to the $69,000 IRS annual cap minus their pre-tax contributions and employer match. Step 2. Once after-tax contributions start hitting your account, convert them to Roth immediately. This is critical. After-tax contributions do earn investment returns, and those returns are pre-tax. If you wait 6 months before converting, you'll have a mix of after-tax principal, which converts tax-free, and pre-tax earnings, which are taxable on conversion. Convert fast to minimize the taxable piece. Step 3. In your plan's Roth account, invest the converted funds in your chosen index funds or target date funds. These dollars will now grow completely tax-free. Step 4. Track your after-tax contributions on IRS Form 8606 each year, the same form used for the regular backdoor Roth. This creates a permanent record of your tax basis so that at retirement, the IRS knows which withdrawals are tax-free. If your employer's 401k doesn't support after-tax contributions or in-plan Roth conversions, you have a few paths forward. First, advocate for it. Benefits teams often don't realize that employees want this feature. A few employees asking HR to add after-tax contribution capability and in-plan Roth conversion to the next plan review can sometimes get it added. It costs the employer very little to allow it, and it's a meaningful benefit. Second, use the regular backdoor Roth to its full extent. $7,000 per year isn't the Mega Backdoor Roth, but it compounds significantly over time. Third, if you have any self-employment income, freelance work, a side business, anything, you may qualify for a solo 401k for that income, even while maintaining your employer's 401k. A solo 401k for your side income can allow after-tax contributions and conversions on top of what you're doing in your employer plan. And fourth, consider maximizing taxable brokerage accounts with tax-efficient index funds as a supplement. It's not the same as Roth, but with careful asset location and tax loss harvesting, which we covered last video, a taxable account can be quite tax-efficient. Let's zoom out and look at what this actually means over a career. Say you're 35 years old and you start contributing $30,000 per year in after-tax contributions to your 401k and converting them to Roth immediately. You do this for 30 years until age 65. At a 7% average annual return, those contributions alone grow to approximately $2.8 million, completely tax-free in retirement. Add in your regular pre-tax 401k contributions and employer match, and you're looking at a retirement portfolio that most people can't even imagine. This is why Mega Backdoor Roth is considered the ultimate retirement power move for anyone who has access to it. The system is, confirm your plan allows it, set after-tax contributions as high as you can afford, convert to Roth immediately, and track everything with Form 8606. That's it. Next video, we're switching gears to talk about 529 college savings plans, the tax-advantaged way to save for your kids' education, including a brand new rule that lets you roll in used 529 money into a Roth IRA. Subscribe and don't miss it.